One of the many benefits of being a Mott's Wealth Management client is the opportunity to meet and speak with industry specialists and professionals. Our speaker for the Forecast 2017 event is Melissa Motts, President of Mott's Wealth Management. She has over 25 years' experience in the tax and financial industry, is a CFP, CPA, and has a master's in taxation. This presentation was recorded on January 25th, 2017.
So thank you everyone for coming on this beautiful, almost spring-like day today. Yeah, it's in a week we're going to know whether we're going to have an early spring or not from Puxatawney Phil. Yeah. This is our annual forecast event, and we want to give our special thanks to our sponsor this evening, John Laudadio from Oppenheimer. Thank you, John. Yeah, we like to use Oppenheimer funds. They do very well. Okay, so where we've been. This has been quite a year, 2016, huh? A lot of unexpected things, like some deaths of celebrities and an election that was an unexpected result, the Brexit vote that was unexpected. There's been a lot of uncertainty going on. Okay, so we're going to practice a couple things here. So, the pundits got a lot of things wrong this past year. So, since you're consumers, let's see if you can guess. What do you suppose, this is an advertisement, what do you think this ad is promoting? Some kind of protection. It's actually for the automatic parking. You know how your car will park itself? Yeah. So the porcupine in between the bottles, the bags of...
They're not going to be in business long.
Yeah, right.
Yeah.
How about this one? What do you think that's promoting? Stress relief. That would be for headache medicine. Yeah, I forget which one it is. So what would this be promoting? Spinach flavored Cheerios. Oh, this is for dental floss. For the little seeds in the kiwi fruit. Pretty lame, huh? Yeah, right. And this one is really odd. So that's supposed to be the bottom of a sneaker that's traveled all over New York City. That's like New York City there. And it's for it's a topical anti-inflammatory. So it's a spray-on anti-inflammatory. So I guess if you're running and you ache all over and pick up after your dog. Yeah, it does look like the shoe needs it. And how about this one? Any guesses there? Wi-Fi. Where do you think? McDonald's. Yep. Wi-Fi at McDonald's. Yeah. The French fries. Okay, so here's some headlines. We've had a lot of fake news going on from all different directions. So let's guess about this one. So at West Point, an annual pillow fight becomes weaponized. Is that true or false? It's true. It's true. What's that?
How did they weaponize their pillows?
I don't know, but they became weaponized. Oh, fire them. Yeah, they probably started firing them at each other. Some football positions are linked to high blood pressure.
Count the coach as a football position.
Yes, it is true. Yeah, it's true. The Queen offers to restore British rule over the United States. True or false? False. Yeah, that's false. That was fake. More people have died from selfies than shark attacks this year.
I bet that's...
You think that's true? No, it's false. It's false. It's false. There might be more injuries, maybe. The North Pole is an insane 36 degrees warmer than normal as winter descends. That's true. Yeah, it is true. And Cleveland Indians rattled by deafening sound of Wrigley Field crowds' indigestion. It was reported. These are all things that were actually reported. But that's fake. That's another fake one, too. Yeah. Okay, so let's see if we can separate the facts from the fake facts here. So we've got a lot of things going on now. Where are we going? I mean, this picture up here on the left shows all these different things up in the air. I mean, what do we have now? We have drones making deliveries, and we have automatic cars driving themselves. And I mean, you know, we're like approaching the Jetson age in many ways. So it's pretty cool. And then we have fast, and then we all have slow. We also have slow is becoming more popular, like slow travel, slow food, slow eating, more experiential. People are spending more money on experiences as opposed to things. So these are some different trends that are going on. So here we are. We're all ready for 2017, here to serve you. This is the Standard & Poor's Index, which hit another record today. Hallelujah, I'm here on a happy day. Lucky me. Can you hear an amen? Exactly. Yeah, so I think I had a note, I think it was 20, what did it close at? 22, I was 84 or something like that, somewhere around there today. So we remembered the big declines we had in 2000 to 2002, and then again 2008 to 2009. And in 2013, we surpassed the last high. And we had a rocky year, like some points in 2015 and 2016. Things took some dips there, but we have come back. So we've come back. And of course, after the election, which we'll talk about that a little bit. But, you know, that was definitely unexpected, you know, that Mr. Trump would win, and unexpected as to the result. But I'm happy. I'm happy the markets are up. I'm happy things are going well. This is something else I'd like to bring to your attention. All the red dots on here are all the intra-year lows, okay? So every single year, and this goes back to 1980, okay? The low is lower than where the year ends, always. Always. And it's just something to keep in mind. You know, I mean, even years where we have gains, we've had corrections in there. You know, so it's just a natural part of the market. So it's not something to freak out over, to think that, you know, the world's ending or anything like that. It's just part of how the markets work. Market volatility during our current market cycle. So our current market cycle would have started in 2009, and this is considered a bull market cycle. And we have had several things happen. Now you look back at them, and it's easy now to look back and say, oh yeah, that was then, and everything's good now. But you never know where things are going to go from here on out, you know? And back then, we didn't know where we would be today, for sure. So, I mean, you remember the BP oil spill, the flash crash, the Europe-Greece issues, and then that came back again, Europe-Greece, and the double dip in 2012. The U.S., our debt rating was downgraded. That created a big market turmoil there. The bottom line is volatility. So volatility, when that goes up and spikes, that's typically when markets are down, you know, close to their low. And then volatility goes down, and then markets recover. That's typically what that means. We have in 2013, you know, the Federal Reserve said they're going to start raising interest rates and tapering off the support, the money that they were injecting into the economy. So that caused some nervousness and some volatility. And then we remember most recently the oil prices, right? A year ago, oil was down in the 20s, and now it's back up to 53. You know, and at that time, the headlines were all saying, oh, it's going to go down into the teens, it's going to stay there. You know, I mean, the extremes never typically stay. You know, they happen, and then things revert back to more the mean. And one thing I want to point out is, you look here, we can see different market corrections. So there's crash of 1929. There's different things. There was a tech crash actually in 1970. There was civil unrest, etc. Then we have the 1987 crash down here, number 8. That lasted 3 months, that correction, that bear market. Then the tech bubble, when that burst in March of 2000, that lasted 31 months, almost 3 years. And we can see not all of the times the markets had entered a bear market territory went down, not always was there a recession. Some of the times there were just extreme valuations. And that's what some people are saying now, that we're getting extreme in our valuations as we're hitting new records, all the time. But we really aren't. We'll go over that too. And then the other thing that a lot of people are saying is that this has gone on for so long now. Since 2009, we've been in this bull market. Can't keep going. And I'll show you, there's a slide that kind of refutes that a bit too. So we'll look at that. This is a slide I usually show. It's just to show that when interest rates, federal rates on federal bills and bonds are less than 5%, so from that line over, and interest rates start being increased, they start going up, stock prices go up. If interest rates are over 5% and they increase, stocks go down, typically. So we're in this area right over here. So even though interest rates are going to be going up, they're probably going to be raising them this year several times. If history repeats itself, that's going to be okay for the stock market. It'll still be a good place to be. And then this is a long scale composite going back to 1900, just showing different times and how they've gone. And the thing that really some of us that are old enough remember were these nice years in the 80s and 90s when we had 20 years of a pretty long bull market in there, except for that flash crash of 87, and there was another time in there when things went down a bit, but pretty good returns. And since then, since 2000, we were just trying to get back to even again, and now we're surpassing that. So hopefully we'll see another nice run here continue. So this is one of the things I wanted to just point out is that this blue line at the bottom, this is what our economic expansion or recovery looks like. So when you look at other recoveries that have happened, back through the years, going back into the 40s, see how steep they are? So we have a recession, a bear market, and then when things recover, they recover like they really go up much more quickly, but they might not last as long. So you can see our recovery here in blue. It's very slow, low growth recovery. Okay? So the fact that it's lasted as long as it has, we're still not up into any territory there that would necessarily pull it back down again. So you have to look at not just the length of it, but you have to look at the degree of recovery to see, if we're getting too overpriced here. Housing prices, they have really come back. I don't know if any of you check your housing prices on Zillow or any place like that, but housing prices have really come back. So that's been a real positive, especially since lending standards, the graph down here in the bottom corner, shows that the FICO scores are still higher, before someone can be approved for a mortgage. So we're not back to where things were back when things got out of hand, earlier, a decade ago. Has anybody seen The Big Short, that movie? If you haven't seen it, you should watch it. I'm really serious. It's an excellent depiction of all the things that were going wrong and how it fell apart back in the financial crisis. But we're nowhere near that, even though now and then you'll see a headline saying, certain types of loans are starting to get into the risky territory again. So, keeping an eye on that. But rates are still low on mortgages, but the prices have come back up. So now they're up above where they were at the high of 2005. So that's good if you own a home, not so good if you're buying a home, because then it gets more expensive to buy. And just looking at the long-term drivers of economic growth, over here, on this side right here, this is why our recovery and our expansion after the last decline has been so slow. I mean, these other expansions, growth, there have been growth in workers is the blue, okay? So like I graduated from high school in 1975. I mean, there were tons of us, coming into the workforce in the baby boomers. So same thing in the, prior to me and same thing after. So there were a lot of workers entering the workforce. So that's been declining and that's really small now, okay? So that's where our growth comes from. People getting into the workforce, buying cars, buying houses, etc. And then also productivity growth. So when technology was really booming and new things were coming out, each worker could produce more. And, and that would increase and increase and increase. That's been pretty stagnant here. So, it's really hard. I mean, I know there are policies that are going to be implemented, under the new administration to try to spur growth and get it back up to a higher rate. But, there are some headwinds that are going to be fighting, just to point that out. The oil markets, I mean, they were way down here a year ago, and now they're up over $53 when this was made in December 2016. And the important thing, if you look at the graph 2017 prediction and 2016, see the consumption, global production, the first one, for 2016, total 96.1 millions of barrels per day versus the consumption, 95.4. They're getting closer. 2017, it's expected to be 97.4 of production and 97 per day of consumption. So as they get closer, price stabilizes. When there was a lot more being produced than could be consumed, that's when we had a glut, that's when we had big inventories, that's when the prices really came down. So that's coming together, and you can see that here, where active rigs have gone down, and as the price has been starting to come back up, they're coming back up a little bit, and inventories have peaked, and they're coming down a bit. This is something that we look at from a recession standpoint. The yield curve, typically, when it starts to flatten, so if it's like this, it's usually good. If it gets flatter, and that means that long-term interest rates are either coming down or short-term interest rates are coming up, and if they start to flatten and invert, then that typically says you're going to have a recession. Okay, but here it's still on the upswing, it's just a little flatter, so that's something that we watch. And this is something that I think I just want to bring up just to show. So U.S. bond market in 1989, the end of 1989, U.S. bonds in dollars made up 61% of total bonds in the world. Now 37%. So even though there's a lot more debt, we have a much lower percentage than we used to of the total world's debt. And there were a couple things I just wanted to mention real briefly. One was how stocks perform in a new president's first 100 days of office. So these are some statistics. Typically, 70% of the time, the market's higher in the first 100 days, okay? So for the first 3 months. And the average is 1.6% up change. So that's a good thing. So we've got the odds that, that will prevail. But I thought this was interesting. And this is not, if this is, I'm neutral as far as Democrat or Republican. But the Republicans' president first 100 days, typically it's down 0.4% in the first 100 days. And the Democrats are up 3.5%. And then it averages out. Right now we're off to a good start this year. So hopefully this year will be different. And one other thing I wanted to just point out was, so for 30-year-olds, and this has to do also with the potential in our economy. Back in 1975, so when I graduated from high school, 90% of 30-year-olds lived on their own. Yeah, 90%. 2015, 70%. 89% had married. 57% now married. Living with a child, there were 76% in 1975. So 89% married and 76% had a child already by the time they were 30. Now just 47% in 2015. And owning a home. In 1975, 56% of 30-year-olds owned a home. Isn't that something? Now 33% for 2015. So the most common young adult living arrangement for the first time on record are that millennials are living with their parents. So this is the first time on record. They're less likely to be married by the time they are 34 than any previous generation. One possible major cause for the delay could be student loan payments. Okay? So in a survey from Bankrate.com, more than 56% of millennials said they have delayed a major life event because of their student loan debt. Okay, so it's just, just to put some context in there. Our currencies, by the way, now is a really good time to travel to Mexico because the peso has really gone down in value. So the US dollar buys a lot more, margaritas in Cancun. So yeah, so US dollar, very expensive relative to other currencies. And as our central bank raises interest rates this year, which they most likely will, because we are hitting all-time lows in new unemployment claims, and there's all kinds of good things going on. So the one really good thing is the economy's in really good, healthy shape right now. So the new administration is really inheriting a good, healthy economy. But the US dollar could be a drag on our exports, okay? So we can see, we know, like we go down to the UK, they're below the average, and that's from the Brexit. Their stock market has come back well, but their currency is still much lower than it used to be. So it's a great value to go to Europe now, to the UK, to Canada. You can see all the ones that are below average there. But it's very expensive for them to come to the US. I know I met a gentleman, we were down in Florida in November, and he was from the UK. He was telling me what he paid for the small plain coffee at Starbucks, was like, I don't know. I forget how much it was like compared to what he would get, in the UK, but it was just crazy. So it's really, it's good for us as travelers. We can go and we can spend our money. It's worth a lot more. And this could be a place where money is coming from to help fuel our economy. So one of the places is young people, right? If a lot of them haven't bought their first homes yet, or they haven't, formed their families yet, and they, when you have a young family, you spend a lot of money, right, Christine? Yes, and all the things children need, and daycare, and just all the things that go along with it, the house, the everything. So with families waiting longer to form their families, there's a lot of potential there, and then there's still a ton of money in cash. Tons and tons of money in cash that's not invested yet. So that can help fuel, our economy as people are feeling much more optimistic. I mean, that's another, we're at like real highs here for optimism from consumers about the economy under the new administration and this change. So, so there are a lot of good things happening. Any questions before I move on? No? Okay. Please fill out your evaluations. We'll collect those. And again, thank you so much for coming. Have a wonderful spring. We'll be back again here for the young adult event, and have a good spring. Thank you.
I hope you enjoyed listening to Melissa Motz, and if you have a friend or relative who is considering their financial options, please feel free to invite them to accompany you to one of our upcoming events. Visit our website at www.motzwealthmanagement.com for the most up-to-date listing of these events. Over the years, many of our clients have asked Melissa to speak with a friend, relative, or colleague concerning private financial management. Melissa considers it an honor and a privilege and has been happy to accommodate those wishes. For your future reference, please be aware of the standards by which she complies with such requests. First, confidentiality is the cornerstone of our business. Each of our client relationships is distinctly separate and totally private. Second, thoughtful and courteous service is guaranteed. This is a people business. Finally, Melissa will never give advice and counsel to a client without thoroughly understanding his or her needs. Please contact us at 215-513-6240 or send Melissa an email at melissa@motzwealthmanagement.com. Melissa H. Motz is a registered representative, securities offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA SIPC. Melissa H. Motz is an investment advisor representative, Cambridge Investment Research Advisors, Inc., a registered investment advisor. Motz Wealth Management and Cambridge are not affiliated.